Hello friends, hope you all are doing good. This is the third tutorial on IFRS 15 revenue from contract with customer. In the first video lesson, I talked about the overview, the scope, and the applicability of the standard. In the second video lesson, we talked about the five-step revenue recognition model, and we started with the first step, which is identifying the contract with the customer. In case you have any questions, please do visit those video lessons. And don't forget to please hit the like and subscribe button in case you like those videos because that will really motivate me to continue making such video lessons in future. Thank you so much. Now coming back. In this video lesson, we will going to talk about some of the special considerations relating to the contract. So let's say when we enter into a contract, there can be a case that you already have one contract or you enter into a new contract. Another case can be you are entering into two contracts simultaneously. In that case, how do we account for both the contracts? So the standard says there can be three possibilities in which the contract may be considered as a single contract or a separate contract, whether the contracts are negotiated with a single commercial objective, whether there is a price or consideration dependency of one contract on another contract, or are the contracts considered for a single performance obligations. If answer to any of these questions is yes, then it will be accounted for as a single contract, else we will account them as a separate contract. Now let's understand them with the help of some examples. Let's take an example of a software company that enters into two contracts simultaneously. One contract is for the purchase of a software license. The another contract is for the customization of the license. Now, whether this will be considered, these two contracts would be considered a single performance obligation or a separate performance obligation. And when will the software company recognize the revenue? Now, from the perspective of software company, it is giving a license for 100 people and it is also ready to customize that license for the business. What the customer is expecting? The customer is expecting an integrated customized software from the software company which works for his specific business. So essentially the customer is going to get a customized software and a license without any customization will not be worth. In this scenario, we will combine the contract and treat it as a single performance obligation. So the software company will going to recognize the revenue when the final delivery of the customized software will happen, that is on 31st December 2019. Let's take another example. Let's say there is a real estate company and it sells a land and it also enters a contract to build a three-floor house on that land for the customer. Now again, looking from the customer perspective, what is the customer getting in this case? Can the customer benefit from the land itself without a building? What if the value of the land goes up in the market? Can the customer sell that land in the market? The answer is yes. So we talk on behalf of the customer, and in this scenario, the customer is getting the land along with the construction, and therefore these two contracts should be considered as a separate contract. Now, if we look into the same example for the software company, let's say the software company says, okay, you are taking the license for X amount, but I will take another amount for the customization from the customer. Or I will leave some of the amount in the customization in case you are buying the software license from me. In this kind of a scenario, the price of one item depends on the sale of the other item, which means that both the license and the customizations are packed in such a way that the prices are related to each other. So it will be considered as a single contract. So if the performance obligation is single, even if we enter into multiple contracts, they will be still treated or accounted as a single contract. Next is the contract modifications. Now, what is a contract modification? Keep it in simple words. If you already have a contract and you enter into a new arrangement, that is modification. Whether that new arrangement now will be accounted as a separate contract or should it be combined with the existing contract only. As per IFRS 15, there can be three possibilities here. If the scope of the contract increases and the consideration also increases for the additional scope as per the market price. Second case could be I have already consumed a part of the contract and now I am looking for additional contract or additional services. In third case scenario, I have already consumed part of the contract, but I am also looking for some sort of benefit for the rest of my contract. Now help to understand we will try to understand each of these scenarios with the help of some examples so that we are very clear. Now let's say I am already buying goods from the supplier and I am asking for additional goods. Whereas for those additional goods, I am also ready to pay a price which is the market price at that point in time. So for example, if I'm buying 100 units and I'm ready to buy additional 50 units, and for those 50 units, I'm ready to pay the market price or the standalone price for 50 units. That means I'm entering into a separate contract, which is separate from my original contract of 100 units. Case 2. In case 2, I have already consumed some part of my services and now I'm requesting for additional services from the supplier. And for this additional contract, the supplier is ready to give me some sort of benefit on the pricing. In the third case, let's say I am using a service provider, for example, Airtel, and a new service provider comes up in the market with some beneficial price of the same services. So in that case, I am looking for a discount on my existing services. So the scope of the contract is not getting changed. However, the price is getting changed. Now let's understand these three cases with an example. Let's say I'm using the data or the internet service from a local vendor. This vendor is selling this plan for 800 per month and I have done the contract for 2 years. Now after 1.5 years of service, a new service provider comes up and he's ready to sell the same plan for 600 per month. So I went to my service provider and asked them that I want to switch to this new supplier. So there can be three cases. The service provider says that I am not concerned who is the new supplier, but I will still continue to charge the market price, which is 800 per month for the rest of the 6 months. And in case you want to do an additional contract for 2 years, that will also be at the market price. In this case, the two contracts will be treated as a separate contract, and the revenue recognized by the service provider would be 800 per month for 6 months in the original contract, and in the new contract, it will recognize a revenue of 24 months. In scenario 2, the service provider would say, okay, for the rest of the 6 months, I'll make your plan for 600 per month. And for, let's say, additional 2 years contract, I'll give you a contract for 500 per month. So in this case, the service provider is not only giving me the discount, but also offering lower than the market price for the additional 2 years contract. So in this case, I will consider this as a termination of my existing contract and a new contract for 2.5 years, which means I will be paying to the service provider 600 for 6 months prospectively and 500 for 24 months, a total of 15,600 for 2.5 years, and my effective price or the revenue for the supplier would be 520 per month. And finally, in the third case, I am not looking to get any additional services or additional distinct services. I am just looking for the discount on my remaining contract, else I am ready to leave the contract. So for practical purpose, in this case the revenue gets revised through a catch-up adjustment. So the revenue that was already recorded for 1.5 years or 18 months was 14,400. However, the cumulative revenue after modification would be 14,400 that I've already recognized plus 500 for the 6 months remaining, which is 17,400. So the effective price for 24 months would be 725 per month, and the revenue that is overstated would be $1,350. So essentially, I would need to pass a revenue adjustment entry to downward state my revenue by 1,350. So this is my third case scenario where the remaining services were not distinct, but they were the part of the same contract and they were partially satisfied on the modifications. And the remaining services, I will just going to do the adjustment to the revenue on a cumulative catch-up basis. So this is precisely the contract modifications. And in next video lesson, we will going to start with the second step, which is identifying the performance obligation in the contract. Thank you so much.